The story of the 2008 crash is not just another chapter in financial history. It is a warning carved in numbers, charts, and mistakes the world keeps repeating. In the years leading up to the global meltdown, only a handful of people understood the threat building beneath the surface. One was economist Nouriel Roubini of NYU, who warned in 2006 that excessive household debt, overheated property markets, and fragile banks could trigger a systemic collapse. Another was investor Michael Burry, who analyzed mortgage data and discovered that subprime loans were wildly Ray Dalio, founder of Bridgewater Associates, highlighted dangerous levels of leverage in the global banking system. Their predictions were dismissed, mocked, or ignored. But when the cracks appeared and the global economy froze, the world suddenly realized they had been right. Today, many of those same analysts are issuing new warnings for 2025. Their message is simple. The same forces that tore the system apart in 2008 are only bigger, faster, and more global than before. To understand why these experts are concerned, we need to look at the deeper economic cycle. Ray Dalio describes it as the long-term debt cycle, a repeating pattern where borrowing rises for decades, asset prices inflate, and eventually the system becomes too fragile to sustain itself. In 2008, the trigger was the U.S. housing market. But in 2025, the pressure points are far more widespread. Government debt, corporate debt, and household debt have simultaneously reached historic highs. According to IMF and OECD data, global debt reached more than $300 trillion in 2023, far above the levels that preceded the last financial crisis. In many countries, debt-to-GDP ratios remain elevated, while interest rates have increased sharply from near-zero levels. This creates a dangerous dynamic. The world is more indebted than ever, and the cost of carrying that debt is rising at the fastest pace in decades. In Dalio's historical framework, this combination often marks the late stage of an economic cycle and signals rising vulnerability. Michael Burry, known for his data-driven approach, has pointed to several market indicators that echo conditions from 2007. He has highlighted unusually high levels of speculative trading, rapid growth in unsecured consumer credit, and asset prices that appear disconnected from underlying economic fundamentals. Burry has repeatedly cautioned that short-term optimism often hides long-term fragility. In 2005-2006, he carefully studied mortgage default risk long before Wall Street acknowledged the problem. Today, he notes that corporate balance sheets are stretching under refinancing costs, while consumers face rising interest burdens on mortgages, credit cards, and auto loans. Even though economic headlines often appear positive, he warns that stresses build quietly, especially when households rely on borrowing to maintain spending. In his view, financial markets in 2025 are showing the same patterns of overconfidence that appeared just before the last crash. Nouriel Roubini, nicknamed Dr. Doom after correctly forecasting the 2008 crisis, has also issued a series of warnings about 2025. He emphasizes that the danger today is not limited to a single market segment. Instead, it is what he calls a mega-threat combination. Roubini points to elevated public debt, geopolitical tensions, slowing global growth, and financial systems exposed to higher interest rates. He has noted that many developed countries are now struggling with a combination of high inflation and rising borrowing costs, a rare mix that historically strains government budgets and banking systems. Roubini also observes that housing markets worldwide have begun losing momentum after a decade of price increases, fueled by low rates. In his analysis, abrupt changes in interest rates often expose hidden weaknesses, just as they did in 2008 when adjustable-rate mortgages reset and triggered massive defaults. Another respected voice is Jeremy Grantham, co-founder of GMO, and known for accurately calling major bubbles, including the dot-com crash and the 2008 crisis. Grantham argues that current valuations in stocks and real estate resemble the late-stage phases of previous historical bubbles. He describes 2021 to 2023 as a period of super bubble conditions, and although markets can stay elevated for long periods, history shows that all such bubbles eventually unwind. Grantham does not predict a single catastrophic day like 1929. Instead, he warns of a prolonged downturn that gradually erodes wealth, similar to Japan's long decline after 1990. His concern for 2025 is rooted in structural factors: demographics, slowing productivity, climate-related disruptions, and stretched corporate profits. In every major bubble he has studied, the pattern is the same: investors ignore risk until reality forces a correction. Beyond expert predictions, global economic data adds weight to these concerns. The World Bank has repeatedly warned that global growth is slowing and that more than half of developing countries face a risk of debt distress. In the United States, interest expenses on national debt have climbed to record levels, surpassing spending on many domestic programs. European economies face stagnation, while China, once the engine of global expansion, is grappling with its own real estate crisis and slowing investment. These trends mirror conditions seen before past periods of instability. When large economies slow simultaneously while carrying heavy debt loads, the global financial system becomes highly sensitive to shocks. Even relatively small disruptions, such as bank failures, geopolitical conflicts, or commodity spikes, can trigger contagion effects. Another historical parallel lies in banking vulnerabilities. In 2008, excessive leverage and exposure to risky assets created systemic fragility. While banks today hold more capital than before the crisis, new risks have emerged. The rapid collapse of Silicon Valley Bank in 2023 revealed how rising interest rates can destabilize institutions holding long-duration assets. Similar weaknesses exist in other sectors, including commercial real estate loans and private credit markets. The IMF has warned that a sudden tightening of financial conditions could expose stressed lenders worldwide. These risks resemble the hidden fragilities that existed before 2008, difficult to detect until pressure builds, and then suddenly overwhelming. History shows that banking systems often appear healthy until confidence evaporates. Even consumer behavior shows echoes of the past. In the years leading up to 2008, household spending increased faster than income as families relied on credit to maintain lifestyles. Today, inflation has eroded purchasing power in many countries, while credit card balances and personal loans have reached record highs. Delinquency rates, while still manageable, have begun to increase. Economic historians note that rising consumer defaults are often the earliest signs of broader financial stress. When households struggle, corporate earnings eventually weaken, government revenues fall, and banking systems absorb losses. It is a chain reaction seen repeatedly throughout economic history, from the Great Depression to the savings and loan crisis to the 2008 collapse. So what makes 2025 such a significant year in these forecasts? Many analysts point to the convergence of multiple timelines. A large share of corporate debt issued during the low-rate years between 2017 and 2021 is set to mature in 2025, meaning businesses must refinance at significantly higher interest costs. Several geopolitical flashpoints, including trade tensions, resource shortages, and regional conflicts, remain unresolved and could impact global markets. Additionally, many countries will reach critical fiscal thresholds where rising interest expenses restrict government flexibility. The combination of refinancing pressures, geopolitical risks, and fiscal strain creates a window of elevated vulnerability. In financial history, major crises often occur not because of a single event, but because multiple stress points align at once. If history truly is repeating itself, the lesson is not panic, but preparation. The experts who predicted 2008 did not rely on fear. They relied on data, cycles, and patterns. Their warnings for 2025 do not guarantee a crash, but they highlight conditions that have led to instability in the past. The key message is awareness. Economic cycles are natural, but their impact is shaped by how individuals, institutions, and governments respond. Understanding the underlying forces like debt accumulation, interest rate shocks, and asset bubbles helps separate signal from noise. And while no one can predict the exact timing of the next downturn, recognizing the early signs allows people to make informed decisions, avoid excessive risk, and navigate uncertainty with clarity. If you enjoyed this deep dive into the repeating patterns of financial history, make sure to like this video, subscribe to the channel, and share it with someone who follows the markets. HistoriNomica brings you clear, engaging stories from the past that explain the world we live in today. Thank you for watching, and stay tuned for more videos that decode the hidden forces shaping our global economy.